Hi, this is Alex Beyer, and today I just want to talk a little bit about cost segregation and what that is. So cost segregation is probably one of the number one real estate strategies in order to help reduce your tax burden, help you get to increase the depreciation on the properties. Because right now, when you buy a property, and you generally you can get deductions on that property, but it's based on, if it's a residential property, you have to get depreciation, and depreciation is a deduction on your tax return. You get depreciation, but it's spread out over 27.5 years. And if it's commercial property, then it's spread out over 39 years. So if it's, I've just got some notes here. So if it's over 27 and a half years, then you're looking at around 3.63% a year is what you get to deduct on the property. And if it's commercial over 39, you're somewhere around 2.72% a year is what you're getting to deduct. Which, it's nice you can deduct the property, but who knows? And if your property is really going to last that long, we all know that roofs aren't going to last that long. We know that the paint and the siding aren't going to last that long. They're all going to have to be replaced. The carpeting, the tile floors, and the brick and veneer and things like that, they're going to break off, and we're not going to get those. So actually depreciating over that amount of time is going to make you have less depreciation than what's actually going to happen on the house when you're having to do replacements. And so we're going to take an example of a property that's if you're doing cost segregation, $1 million property. So generally, if you're going to do that, all right, if you bought $1 million property, so this is after you separate your land cost and the actual building cost. And a lot of times you're going to find that based on your assessed value. They're not always right on the percentage. Sometimes you have to get an appraisal on it, but we'll just say that the land value, not the land value, but the actual improvements value is based on $1 million on a property. All right, we'll do it on a residential property. So if it was $1 million that you had there, if you were getting a 3.63% depreciation, then that year, over the next 27 and a half years, then you get to depreciate the property at $36,363 per year. Okay, that's a deduction. So that's not what you actually save, but that's a deduction off of what your income would be otherwise. And depending on how you hold it, whether it's in a business entity or personally, you can, if you do it correctly, then you can get that. Then it may not just apply towards your passive income. So at that, that's all you're going to get. And at a 33% tax bracket, basically you're going to be saving about $12,000 in taxes that you would have been paying on the property because you had that as a deduction. So that's about 33% of the $36,000. So that would be your tax savings, about $12,000 off that $1 million. So about that much per year. Now, with the same property, with that same $1 million, what if you could deduct, who knows, somewhere maybe 20 or 25% during the first year? And what the cost segregation does is it says that on our tax returns, instead of we're going to depreciate this property equally over 27 and a half years, what if we broke down the property into its separate components? You broke it down into its roof, into its siding, into its paint and its flooring and the the water heater and the other parts of the property that are in there, the other improvements, the sidewalks and things like that. We all know that the paint's only going to last a couple of years, maybe 4 or 5 years, and it's going to have to be replaced. And we know that the roof, it might last for, 7, 10, 15 years or so. It's not going to last that 27 and a half years or even 39 years. The air conditioning unit is not going to last that long. So what if we broke those down and we're able to take some of those components and depreciate them quicker, maybe over a 5-year period or over a 15-year period, or maybe a percentage of it immediately. Right now, there's bonus depreciation things that you can do, or anything that could be depreciated in 20 years can be depreciated quicker. Sometimes it's 100%, sometimes 80%. Right now it's going down, but they change it every once in a while. So that's a thing that you get in there. But say you could get the 20 to 25%, if you broke down the components in your property, and you could get 20 to 25% of the property components depreciated in the first year that you had. So take that same $1 million property. If you could spread that out, each of the pieces and what they were, into different components, and you took that $1 million and we're just going to use a ballpark, somewhere around 20, 25. It could be more. It could be based on whatever the depreciation values are or what your property is built out of. But using that, off that $1 million, 25% is going to be somewhere between $200,000 to $250,000 on a deduction for the first year. And that's not including the other components that even if you couldn't do it over just the first year, you're still depreciating a number of things over 5 years or 15 years, and then there'll still be some of that 27.5. So if you're able to deduct the $250,000 at a 33% tax bracket, then you're really looking at somewhere between a $66,000 to $82,000 savings on the taxes that you would have paid on those amounts, or that you could deduct against other taxes that you were paying elsewhere. And if you have it in, say, an entity, and you're able to deduct that against other properties or other income that comes in on those properties, and if you get your K-1 at the end of the year, then it's going to come down to your personal tax return and potentially help reduce taxes on your personal tax returns for income that you made on a W-2 or from other sources. So that's just one thing. So having on that type of a situation, saving somewhere between $66,000, $82,000, and depending on the property. This works on residential properties, it works on commercial properties, it works on gas stations and supermarkets and car washes and all kinds of real property that's out there that can get these type of benefits. So one of the things that we talk about and talk about some strategies with is this cost segregation, where we can, instead of depreciating things over 27.5 to 39 years equally at that 2 to 3% per year, then we try to get somewhere between potentially the 20-25%, sometimes even more depreciation just in that first year that we can deduct on our taxes. So if there's something, if you want to come in and talk, go ahead and give us a call or give us an email and we can talk about it some more.